This is Chris Carlson, and welcome to the Boulder Banking Podcast. My guest is Todd Taylor, founder and president of Taylor Advisors, and a faculty member of the Community Bank Investment School, sponsored by GSBC. In this episode, Todd talks about the value of the Community Bank Investment School and offers valuable insights into the challenges and opportunities that banks face in managing their investment portfolios, emphasizing the significance of ongoing education and training. From discussing the evolving roles of investment portfolios in different rate cycles to addressing concerns and strategies for navigating industry challenges, Todd provides a comprehensive overview. Tune in to gain a deeper understanding of the intricacies of community bank investments and how industry professionals can stay ahead in this dynamic landscape. Hey, Todd, thanks for joining us today.
Great, Chris. How you doing?
It's a great day in the state of Kentucky, my friend. And I know you feel that way over there in Louisville. We talked about how the weather's actually cooperating for us today.
No doubt. Very nice for sure.
Hey, Todd, I'm really looking forward to our conversation today. But before we get started, can you give us a brief background of Todd Taylor?
Yeah, sure, Chris. We don't have to go back too far back, but I definitely been in this in the banking space for over 30 years. Interesting enough, the first 10 years, I worked for a $3 billion community bank and was lucky enough to have a good career. But then the bank got sold. And at that point in time, I went out on my own and created a company called Taylor Advisors. And so I've been doing that. We currently have about over 140 banks in 27 states. And basically, we do balance sheet management and help banks improve or protect profitability. So in a nutshell, that's what we do.
So, Todd, I got to ask you a crazy question. How do you go from 0 to 130? That's some good business development techniques.
Well, I tell you what, I've been very fortunate over the years. When I first started in the business, I learned that speaking and writing research has been very critical in getting your name out. So by doing that, once I spoke at the Kentucky Bankers, Indiana Bankers, and several other of them, people heard us and they contacted. And so really have done from Federal Home Loan Bank, various state banking associations, the American Institute of Public Accountants, even did some training for regulators. So really fortunate that people have found our education valuable. And then we've probably, you can go to our website and you can check out the articles, but I guess since we've started, we've probably published over 100 articles on various topics: liquidity, capital, investments, funding, hedging, all that. Very important for banking, as you can imagine.
Absolutely. Well, Todd, we want to talk about one of the programs that is offered by GSBC, and that's the Community Bank Investment School. So can you kind of give us an overview of the Community Bank Investment School?
Yeah, sure. Interesting enough, Mike Stevens and his team has done an amazing job. I like the investment curriculum and the type of education and training they really can deliver it for even a bank manager or even a bank executive. So I think that's a huge takeaway. Very focused on being able to manage or oversee a bank's fixed income portfolio. I don't know, you know this, Chris. I know we've talked a few times, but I've been an instructor there for over 20 years. And I really have seen the program evolve over time. But you know what I think is interesting? Big picture, you got, somewhere between 4 to 5 days of content, 20 different sessions, 8 to 10 different instructors. And the other thing that I think is valuable, that we all come from a different kind of professional background. Some people are from the broker dealer, whether they're a salesperson or an analyst. You have me, a consultant or an advisor. You even have bank practitioners. So when you have that kind of blend of different backgrounds and experience, I think it's, a big win for those students that want to learn and grow in this area.
Well, what do students take away from the school?
Yeah, well, I tell you what, you might have to solicit their opinion, but, if you ask me and as I think about it, I think what the takeaway is really I'd like to break it down in kind of 3 components, because the way a student can learn is really from, a couple of different ways. The ultimate goal is they have to get material. They have to be able to have it sink in, and they have to be able to apply it. I think once you go to the school, I think, obviously there's still, it's an ongoing learning process. but I think they're well on their way. And the way that I would describe it is there's three types of learning. One, the lectures. So as I mentioned, there's 20 different sessions ish. And so the lecture focuses on, like, for example, product knowledge, right? So somebody might come in and not know what CMBS is. They might not understand municipal. So I think you are able to learn, in a lecture format. The other type of training is this idea of they have a Bloomberg lab. And that Bloomberg lab is kind of a tool where you have bond analytics. So you can look at, mortgage-backed securities, commercial mortgage-backed securities, a lot of different things. So bond analytics are valuable. And the third is the workshop format, right? So you can actually go through a case study. The students talk about it out loud. And also, one of my sessions, I speak at two different programs. I do this thing called sector analysis, where I started this about 6 years ago, where I'll give like 18 different investment products and characteristics. And on the screen, the students can go through and they kind of pick out certain things. So I think through lecture, the Bloomberg, kind of lab work and the workshop just is really a home run. Very few schools are able to kind of provide all three of those kind of learning techniques.
So they go through the curriculum. What's so important about then the students going back to their banks and actually implementing what they learned?
Yeah. So if I think about the takeaway, I think you got to go back to the basics. First of all, does the investment portfolio, will that impact the overall profitability of a bank? And depending on how the securities perform, and I'll share something with you about that. So every bank is a little bit unique, Chris, right? And so I call the investment portfolio the ugly stepsister to the loan portfolio because it's smaller, and everybody's in the banking business to make loans. But what you might not realize is that the investment portfolio as a percentage of earning assets can vary significantly from institution to institution. Over the years I've spoke, sometimes we've had people come in and the portfolio might only represent 3 to 5%. But Chris, some people come in and the investment portfolio literally is larger than the loan portfolio, and it could be represent 50 or 60% of the overall bank's balance sheet. Not always, because loan demand might not be there in that market. So I think you have to understand that. The other thing that I think is very important, and I just got back and I spoke earlier this week. It's called the American Bankers Association Community Bankers Event Conference, and that was in San Antonio, Texas. Really loved it. And one thing that I did, I talked a little bit about balance sheet management and investments, but what I were able to pull is that the investment portfolio performance from the 10th percentile for community banks under 15 billion was around 1.6%. Okay. The 90th percentile was a little over 4%. So that range, Chris, from the 10th percentile to the 90th percentile is 2.4%. That's pretty significant when you have bank portfolios that could be hundreds of millions of dollars, right? So that's why it's so important. And the other thing is that when you come back to the school and the takeaway, I always think that performance can be driven from a couple of things. I used to say that, hey, if there's a big range like that, doesn't it make you wonder how come if every community bank has access to the same securities, how come performance can, vary so wildly? Well, the access to the securities they truly can get, there's a methodology that you can learn at the school, or I'm happy to talk about, and then the execution, what they pay. So going to be very important for a student because the portfolio is going to drive a lot, performance for the overall bank. And I just think that it's valuable to understand that if you go to the school and learn, you can find a few basis points over time to better manage the portfolio.
So, Todd, I want to take kind of a global view regarding investment portfolios and ask you, what challenges do banks have regarding their investment portfolio?
Yeah, and it depends on the rate cycle. But, one thing that I would like to talk about for today, right? Portfolios grew during the pandemic, right? And so many banks had excess liquidity. Loan demand was non-existent. So they were able to, purchase a lot of securities in a lower rate environment. Now that rates have risen, the mark to market has caught the attention of a lot of bank board members and executives. So it's a little bit difficult because you don't have the liquidity. Now banks are having loan demand pick up, but the portfolio for some cannot provide liquidity through the investment portfolio. So I really think that's probably one of the bigger challenges of the unrealized gains and losses in the portfolio today.
Todd, you mentioned rate cycles. Do investment portfolios play different roles in different rate cycles?
Yeah, absolutely. It's kind of like the debt cycle. When rates are low, Chris, what happens? The economy might not be overly robust, right? That's why the Fed funds cut rates. Loan demand's non-existent, and then the bond portfolio can play an important role in terms of overall earnings, right? When rates are higher, loan demand is a lot stronger. Maybe the portfolio evolves and that cash flow, we need to have that and provide that to fund. So the portfolio does play different roles for different banks and different rate cycles. I guess that's why you just can't assume that the investment strategy for one bank is going to be consistent in the rate cycle, because there's a lot of things that are going on behind the scenes that you might not be aware of for the respective institution.
Well, what should banks be paying attention to in 2024?
Yeah, I mean, one thing that I'll just start with this is that, and let's move away from the investment portfolio for just a second. So when you ask me what should the banks be paying attention to, let's talk about something that should be on everybody's mind, and it's not, is credit quality should always be front and center for every institution. The proverbial soft landing where inflation comes down and we don't go in a full-blown recession might be overly optimistic. I'm not saying that we're making a call on that. But I tell you one thing that I think is very valuable for overall banks is that we need to pay attention that now that rates have risen, we need to think about the overall bank's asset portfolio. So first of all, let's talk about loans. Now that rates are risen, banks are making loans at higher yields, right, Chris? So they're higher. But what happens when rates come down? People are not mindful of the interest rate risk that an asset sensitive institution, meaning if rates come down, margins compress on way down, meaning earning asset yields collapse. So loans could prepay on the investment portfolio. The reason why we need to pay attention is that call protection on loans, like prepayment penalties on loans, so they don't recycle. But on the investment portfolio, we have to make sure that when rates go down, bonds don't get called in the agencies. Mortgage-backed securities don't prepay fast. So just being really sensitive and focused on this idea of kind of managing cash flow variability, because if rates come down and everything prepays and refinances, then we're going to see lower yields and again affect compressing on the earning asset yield side. I think that would be a big challenge.
Well, what concerns do you have regarding the banking industry overall?
You know what? I think that's it's a great question. But when I think about the concerns, and again, I know we've talked about this, and, as I most recently spoke at a conference, I just think this inverted yield curve has been very problematic, right? For the listeners, most people know, but it's good to go back to basics. But with short-term rates being so much higher than the intermediate part of the curve, right? That's not always friendly to banking and margin, right? And going back, you keep on hearing this word called margin. Well, banks are heavily net interest income dependent, right? They make the most of their money off of margin. So I believe this inverted yield curve is challenging because it forces us to pay a little higher cost of funds on the shorter end, yet we're not able to command a larger margin. Number two, I think that the concerns around funding mix migration. I know that seems like a big word, but what about these low cost or no cost deposits moving either into higher paying products like time deposits at some of these institutions? They could be 4.5%, 5%, right? I just think that on the funding side, accelerating like that just is challenged, right? We saw the Fed funds rate move up, 450 basis points in 2022. Last year, we saw Fed funds rate up another 75. Now, Chris, we're at this point where we've probably reached the Fed funds terminal rate at 5.5%, but the Fed has telegraphed that we might be higher for longer, right? We saw inflation a little bit more elevated with the most recent CPI print. So if that's the case and this inverted yield curve persists, I think that's going to be something that's in concern. And then the other final thing I'd like to share is liquidity. I mean, I think you remember about a year ago, we heard about Silicon Valley Bank and Signature Bank failed. Do you remember that back in February, March?
Absolutely.
So I just think people have to be mindful of contingent funding plans. And I think those institutions got caught flat-footed. So we have spent a great deal of time recalibrating, reinventing some of our liquidity assessment and management processes. The reason for that is, sure, you can do stress testing. Sure, you can identify the various wholesale funding alternatives. But runs on the bank aren't over a course of 2 to 3 weeks. They're over days or even hours. So we spent more time talking and educating on a cash conversion timeline, meaning how can you get liquidity? What are secured borrowings? So those are the two things. If you're talking about the industry, this inverted yield curve, interest rate risk and funding, and then, from a regulatory standpoint, liquidity and assessment management, I guess there's some other things, but those are the two that come to mind.
So Todd, my last question is kind of a crazy question. We have over 4,000 banks in this country, and we're really betting on that we got 4,000 of the right people in the right seats. How confident overall that we're doing a good job as an industry making sure that the people who are making these decisions are qualified and are making proper decisions?
Well, I tell you what, when I talk to my 140 plus clients, there's no question that succession planning and getting the right talent has been a challenge, right? During the pandemic, people have left the industry and people have gone to other positions. It goes back to this training and education and being able to have career paths for young professionals that can work at a community bank, get training, and really seed a good career path for them to go in a lot of different areas. And there's lots from operations to lending to treasury management, right? So it's definitely difficult, but again, there are fewer banks, but we just have to be mindful of is that training, attracting are going to be critical for the community banking market to flourish. If not, the scenario that plays out that if they're not able to have good succession plans, then some of the ownership of these community banks just decide to sell the bank, which I wouldn't be a fan. Community banks have been a very good lifeblood of providing capital to these smaller markets.
Yeah, I think it really speaks to the importance of the community bank investment school. To your point, that we're investing in these people. They have a place to go to become better qualified to take care of their particular institution. So it's a great testament to what the school is doing and what GSBC is doing.
Yeah, absolutely. No, couldn't agree more. And when you think about the investment school, as I said, it involves, you really have these bank managers and executives that attend this program. One, they get to talk to their colleagues, right? And share stories about what you're doing. I think that's equally valuable. But even though it says investment schools, there is some other balance sheet ALCO ideas that are slipped in there. And I think and the reason why I think that is, especially for one of my sessions, investment management from a whole bank perspective, right? It is so critical when you're trying to think and make good decisions in the portfolio. You have to understand what are the uniqueness of my institution. Some banks need pledgeable collateral, right? Because they might have public funds. So those investments will be important. Number two, if risk-based capital is a little bit tight, Then the portfolio manager needs to say, well, should we own a Ginnie Mae, Treasury, or SBA? And finally, even municipals, some banks during the credit crisis, many, many years ago had loss carry forwards, and tax-free municipals didn't make sense anymore. Today, they've worked through all those carry forwards losses, and now they're profitable. So munis make sense again. So as interest rates change, as the balance sheet changes, the way the investment portfolio managed does change. And so I think providing the type of learning at the school is just wonderful because, again, they get to hear about it from different instructors and then talk to peer banks.
Well, Todd, you shared some great ideas today. If anybody has any questions regarding what you talked about or wants more information regarding the investment school, what's the best way for somebody to get in contact with you?
Yeah, sure. Well, there's a couple ways. You can go to search Hub Taylor Advisors or Taylor Advisors. That should come up. But my email address is Todd, 2Ds, .Taylor at hubinternational.com. My phone number is 502-412-2524. And really happy to talk to anybody about the school or, what you might learn from the program or just talk about balance sheet management or investments altogether. Happy to do that.
Todd, I know you're a busy individual. Thanks for taking time out of your schedule to visit with us today.
Okay, Chris. Have a good day. Thank you.
You too.